Back in the early 1980s, watching a movie at home meant dealing with physical friction. The video rental market was highly decentralized. Independent mom-and-pop stores dominated the landscape, operating on a very small scale to serve their immediate neighborhoods. Blockbuster founder David Cook looked at these local shops and identified a structural problem. The bottleneck limiting their growth was not a lack of popular movies, but the limitations of their manual inventory management. This diagram illustrates Cook's solution. Using his background in software, he implemented a custom barcode system. This single logistical upgrade allowed one store to effortlessly track and manage over 6,500 distinct titles. Logistical scalability and data-driven infrastructure provided Blockbuster's true competitive edge, rather than the content of its film library. When Wayne Huizenga acquired the company, he took that data-driven model and applied a strategy of hyper-aggressive geographic expansion. The velocity of this scaling was extreme. Over a span of just 7 years, Blockbuster executed 110 separate corporate acquisitions. That buying spree resulted in a sprawling real estate footprint of over 9,000 global stores, effectively creating localized geographic monopolies in cities around the world. At its absolute peak, this massive physical infrastructure generated $6 billion in annual revenue. This revenue breakdown exposes a deep vulnerability. $800 million was generated strictly through punitive late fees. These penalties accounted for 16% of top-line revenue. With no added collection costs, they carried essentially a 100% profit margin. The company's profits were structurally linked to customer friction, making its most valuable revenue stream a primary source of brand resentment. As the internet matured and digital technology evolved, the tremendous power and value of geographic retail monopolies began to dissolve entirely. In the year 2000, CEO John Antioco took a meeting with a struggling startup called Netflix. Antioco ultimately rejected a proposal to purchase the entire company for $50 million. Netflix was operating on a subscription model designed to intentionally eliminate the exact customer pain points that Blockbuster monetized, removing due dates and late penalties completely. To match this frictionless model, Blockbuster would have had to willingly wipe out its $800 million late fee profit center overnight. For a publicly traded company facing strict quarterly earnings expectations, taking a massive, deliberate short-term loss was out of the question. Blockbuster was mathematically trapped by the very profit model that made them a giant. Internally, the company was also experiencing severe corporate fragmentation. Founder David Cook had departed early on, and Wayne Huizenga eventually exited the board as well. Ownership shifted entirely in 1994 when Viacom acquired Blockbuster for $8.4 billion. Viacom chairman Sumner Redstone had a specific motive for the deal. He needed Blockbuster's massive retail cash flow to finance a bid for Paramount Pictures. This flowchart maps the capital redirection. Cash flow was aggressively drained from Blockbuster's retail operations and pumped into a separate corporate entity. This extraction starved Blockbuster of essential research and development funds as the digital era accelerated, tanking the company's overall stock value. It wasn't until 2005 that Blockbuster made a desperate, belated attempt to repair its customer relations by suddenly eliminating late fees. While agile competitors were heavily investing in the future of media, Blockbuster was being stripped for parts to finance legacy corporate wars. By the late 2000s, foot traffic had permanently collapsed in favor of mail and digital delivery. Top-line sales plummeted, falling from $5.5 billion in 2005 down to $4.06 billion by 2010. A legacy of 9,000 stores shifted from a competitive moat to a massive liability of fixed real estate costs. Financial analysts use a metric called a debt ratio to measure risk. When a company carries high fixed costs during a period of severe revenue contraction, paying the bills becomes mathematically impossible. This balance sheet visualization displays the specific Autopsy metrics of 2010. Total liabilities ballooned to $1.85 billion against only $1.53 billion in remaining assets. Comparing these two numbers produces an unsustainable debt ratio of 120%. By this point, the company was no longer a media retailer. It was a distressed real estate portfolio suffocating under its own fixed costs. Blockbuster sat under the crushing weight of $1.46 billion in total corporate debt, owed to a staggering pool of over 100,000 different creditors. The single largest unsecured liability on the books was approximately $315 million owed to the Bank of New York Mellon alone. The math dictated the inevitable outcome. Blockbuster officially filed for Chapter 11 bankruptcy in 2010. As we have seen time and time again, a corporate structure built to be completely rigid will inevitably fracture under extreme pressure. The company's downfall resulted from a financial architecture so rigid that it offered no escape when the market evolved.